G'day and welcome. Buying a business isn't at all like buying a car. You can't just kick the tires and hope for the best. No, this is a proper high-stakes investigation, and you're the lead detective. Your whole mission is to uncover the truth, figure out what's fact and what's fiction, and protect your hard-earned cash from any nasty surprises. And make no mistake, the stakes are massive. Get this right, and you've set yourself up for the future. But get it wrong, and you could be walking straight into a financial nightmare that someone else created. The only thing standing between those two outcomes is a really rigorous, methodical investigation. So today, we're cracking open the case file. We're going to cover your mission, the expert team you'll need to assemble, the 3 key areas you absolutely have to probe, and how to crack both the financial and the legal codes. And then, at the end, we'll see how all that evidence leads you to your final verdict. All right, let's get stuck into it. Your main mission, your most important job, actually has a name, and it is, without a doubt, the most critical phase of buying any business, due diligence. So, what is it? Well, think of due diligence as the formal name for this whole investigation. It's about lifting the bonnet and making sure the engine the seller told you about is actually in there and, it works. It's all about building trust, but not through words, through cold, hard evidence. And this is where you get your power back. See, due diligence isn't just about finding problems. The info you uncover gives you the confidence, the leverage to either go ahead with the deal, go back to the seller and say, mate, we need to renegotiate the price, or, and this is just as important, to have the courage to just walk away from a dud. Now here's the thing, no good detective ever works a big case alone. To do this properly, you need a specialist team. Honestly, trying to cut corners here and do it all yourself is one of the biggest mistakes you can possibly make. And this quote from Zero, mate, it absolutely hits the nail on the head. The money you spend on hiring professionals is nothing, absolutely nothing compared to the potential cost of missing one huge red flag that could sink the business 6 months after you've bought it. So who's on your team? Well, your 2 most important players are your accountant and your lawyer. Think of the accountant as your financial forensics expert. They're the one who'll dig through all the numbers, check that they line up with what the ATO's been told, and figure out if the profit is actually real and sustainable. Then you've got your lawyer, the legal specialist. They're going to check all the contracts, the leases, and make sure there are no hidden legal dramas waiting to jump out at you. Okay, teams assembled. Now the real investigation can get underway. And it really focuses on 3 main areas, each one a crucial piece of the overall puzzle. Right? So you've got the financial investigation. That's all about the money. Is the business actually profitable? Then there's the legal investigation, which looks at the structure, all the contracts and ownership details. And finally, the operational side, which is how the business actually runs day to day. Now for today, we're going to focus on the 2 biggest chunks of that pie, the financial and the legal. Okay, this is where your accountant really earns their keep. Cracking the financial code isn't just about looking at a spreadsheet. It's about uncovering the true economic story of the business, which can be very different from what the seller's pretty reports might be telling you. And a huge part of this is something called a quality of earnings analysis. It's a really deep dive that cuts through all the noise. It separates the reliable, repeatable profits from, say, a one-off government grant or some creative accounting. It answers the most important question of all. Is the profit this business makes actually sustainable? So, to do this, your accountant needs evidence. We're talking at least 3 or 4 years of profit and loss statements, balance sheets, and crucially, the tax returns and the BAS statements that were actually lodged with the ATO. They'll also want to see sales records, asset lists, the whole shebang. This paper trail is where the truth lives. So what are they actually looking for in all that paperwork? Well, the first major red flag is something called aggressive revenue recognition. It's a pretty common trick, actually, to make a business look way more profitable in the short term than it really is. So what does this look like? Well, imagine a business signs a 3-year contract with a client, but they book all 3 years of that income in the very first year. Yeah, it makes that year's profit look amazing, but it leaves the next 2 years with a massive revenue hole. It's a classic sign of low-quality, unsustainable earnings. All right, the next big one is about what's missing from the books. These are the undisclosed liabilities, the financial ghosts that will absolutely come back to haunt you as the new owner. These are real costs, real debts that can destroy your cash flow from day one.
So your accountant, they're on the hunt. They're looking for things like unpaid GST or pay-as-you-go tax owed to the ATO. Another classic is unrecorded staff entitlements, like years of accrued holiday pay. And of course, there could be pending lawsuits or problems with super contributions that could come with some pretty hefty penalties.
And this is the really clever bit, right? This shows how a good accountant turns their findings into action. They don't just find problems, they tell you what to do about them. So if the tax records don't match the financials, that's a potential ATO penalty. The action? Renegotiate the price down to cover that risk. If the inventory is all old and worthless, well, the business isn't worth as much. Action? Adjust the valuation. This is where your accountant's work directly saves you money.
Right, financial deep dive done. Now, we bring in the legal eagle. Your lawyer's job is to basically map out the entire legal landscape of the business and make damn sure you don't step on any hidden landmines like dodgy contracts or compliance issues.
For so many businesses, the property lease is the absolute foundation. Your lawyer will check the crucial details, how much time is left on it, and this is a big one. Will the landlord even agree to transfer the lease to you? They're not always obligated to. They'll also look at something called the make good clause, which could leave you with a massive bill at the end to rip everything out. Next up, the people. Are all the employees on proper contracts, under the right industry awards? Your lawyer checks this to save you from future headaches with fair work. They'll also double-check the numbers on any outstanding leave entitlements. And really importantly, they'll help you figure out the risk of key staff, the ones the business really relies on, deciding to leave once the old owner is gone. And this is a huge one that people often forget about: intellectual property. Your lawyer will check, is the business name and logo actually a registered trademark? Do they own their own website domain names? Who owns the copyright to all the marketing material? You'd be surprised how often a freelance designer technically still owns it. These are the crown jewels of the business, and you have to be sure you're actually buying them. Okay, so after all that digging, after your team has gathered all the financial and legal evidence, it is time to sit down, review the entire case file, and figure out your final verdict. And when you boil it all down, all of that intense work leads you to one of three pretty simple outcomes. Option 1, proceed. The investigation checks out, the business is clean, the value is there, and you move forward with total confidence. Option 2, renegotiate. You found some issues, so you go back to the seller with a new, lower offer that reflects those risks. Or option 3, walk away. The problems are just too big, and you decide to cut your losses. But look, even if you do decide to go ahead, the investigation gives you some serious tools to protect yourself. A price cut is the most obvious one, but your lawyer can also build in protections like warranties, which are legally binding promises from the seller that, for example, all their taxes are paid up. Or even better, indemnities, which force the seller to pay you back if a specific problem you found, like a lawsuit, actually ends up costing you money down the track. At the end of the day, that's what due diligence is all about. It's about replacing guesswork and assumptions with cold, hard facts. It's the structured process that gives you the clarity you need to make one of the biggest decisions of your life. So the investigation is done. All the evidence is in. The only question left is, what's your verdict?